Hey everyone, Mike DeBlis here. Welcome back to the webinar on your Lifeline for Form 8938. We're now up to Module 3. Here in Module 3, we're going to tackle the reporting thresholds. Now, what do I mean by the reporting thresholds? Well, the question that reporting thresholds raise is how large must a specified foreign financial asset be in order to trigger a Form 8938 reporting requirement. That essentially is what drives the Form 8938 reporting requirement, the value of the specified foreign financial asset. So it stands to reason that we have to know what the value of the specified foreign financial asset is, and we have to know what reporting threshold the taxpayer or specified individual is in order to determine whether there's a Form 8938 reporting requirement. So here are a couple of points to keep in mind. Even if an individual is considered a specified individual and holds an interest in certain specified foreign financial assets during a given year, he need only file Form 8938 if the aggregate value of the specified foreign financial assets exceeds a certain reporting threshold. The thresholds vary based on three variables. First, a specified individual's location. Second, a specified individual's civil status. And third, a specified individual's return filing status. There are 6 reporting thresholds, and in this module we're going to cover all 6. The first one is an unmarried specified individual living in the United States. The rule here is that the specified individual must file Form 8938 if the aggregate value of the specified foreign financial assets exceeds 1. $50,000 on the last day of the year, or 2. $75,000 at any time during the year. So it's important to test for both thresholds. The reason being is because if you only test for $50,000 on the last day of the year and the specified foreign financial asset has a value of, say, $45,000, then you may think that you are clear and free of any Form 8938 requirement. However, if the specified foreign financial asset actually hit a high watermark of $75,000 at any time during the year, perhaps maybe in October or maybe in September, then that alone would be enough to trigger a Form 8938 reporting requirement for an unmarried individual living in the U.S. Once again, I can't emphasize the importance of testing for both thresholds. $50,000 on the last day of the year, it has to exceed that, or $75,000 at any time during the year. And as you can imagine, we're dealing with valuation principles here, and whenever you deal with valuation of a specified foreign financial asset, the first thing that comes to mind is having an appraisal done of the specified foreign financial asset. These are things that we're going to explore in later parts of the webinar, but this concept, of course, is inextricably tied to getting an appraisal done. Second, unmarried specified individual living abroad. A specified individual who is a qualified individual under Code Section 911 during the relevant year must file Form 8938 if the aggregate value of the specified foreign financial assets exceeds 1, $200,000 on the last day of the year, or 2, $300,000 at any time during the year. So just like before, we want to test for both thresholds. In number 1, when we were dealing with an unmarried individual who was living in the U.S., the same principle applies in number 2, where we want to test for the threshold in both alternatives for an unmarried specified individual living abroad. Let's back up for a second and determine who is a qualified individual for purposes of Code Section 911. That phrase was used in number 2. Well, a qualified individual is defined as a U.S. citizen who has been a bona fide resident of a foreign country for an uninterrupted period that includes an entire calendar year. Now, there are a lot of bona fide residence rules that the IRS has, conjured up over the years. So it's very important that you don't confuse this this rule for determining what a qualified individual is for purposes of Code Section 911 with other residency tests. And so I'm going to emphasize once again that a qualified individual for purposes of Code Section 911 is a U.S. citizen who has been a bona fide resident of a foreign country or countries for an uninterrupted period of time that includes an entire calendar year. Alternatively, it could be a U.S. citizen or a U.S. resident who is present in a foreign country or countries for at least 330 full days during any consecutive 12-month period. The last part of that is critical. Any consecutive 12-month period means that the period doesn't have to start on January 1st and end on December 31st. It could start on September 1st of, say, tax year 2005 and end on August 31st of tax year 2006. It's any consecutive 12-month period. And what we're talking about here in number 2 is a period of time of at least 330 full days. So as we all know, there are 365 days in a year, but what this is saying is that 330 full days during any consecutive 12-month period would allow the U.S. citizen or U.S. resident to qualify as a qualified individual. All right, so we're talking about, once again, a U.S. citizen or U.S. resident who is present in that foreign country for the 330 full days during any consecutive 12-month period. That person would satisfy the test for qualified individual. However, you notice that there is a difference in the reporting thresholds. Number 5, married specified individuals living in the U.S. and filing joint forms 1040. The married specified individuals must file Form 8938 if the aggregate value of the specified foreign financial assets exceeds either $100,000 on the last day of the tax year or $150,000 at any time during the year. Number 6, married specified individuals living abroad and filing joint forms 1040. This would be our last scenario. The married specified individual who is a qualified individual, remember that definition that we covered earlier, under Section 911 during the relevant year, and his or her spouse must file Form 8938 if the aggregate value of the specified foreign financial assets held by either spouse exceeds $400,000 on the last day of the year or $600,000 at any time during the year. Excuse me. Now you notice that I italicized the last part of this rule, the part that reads the specified foreign financial assets held by either spouse. The reason why is I wanted to emphasize that one spouse holding specified foreign financial assets that exceeds one of the two thresholds is enough to trigger an obligation for both spouses, not just the one spouse that holds the assets that exceeds the threshold to report on Form 8938, but for both spouses to have to report the specified financial assets on Form 8938. So one spouse, the spouse that doesn't have the one spouse that perhaps has no specified foreign financial assets in his or her name would still have an obligation to, on the joint return, to disclose the specified foreign financial assets just by virtue of the fact that the other spouse possesses specified foreign financial assets that exceed the reporting threshold. So joint filing basically means joint liability, so to speak, in terms of the reporting obligation. All it takes is one spouse with specified foreign financial assets that exceeds the reporting threshold for both spouses to have this reporting obligation. And that goes for a situation like I just described where only one spouse actually has the specified foreign financial assets and the other doesn't. And here is something very important to keep in mind. This is the overlap of Form 8938 and the FBAR. Filing Form 8938 does not relieve a taxpayer of the requirement to file an FBAR if the taxpayer is otherwise required to file an FBAR. So disabuse yourself of the notion that if you've filed a Form 8938 and there's overlap, meaning that the specified foreign financial asset not only triggers a Form 8938 reporting requirement, but also an FBAR reporting requirement, don't think that just because you filed Form 8938 that you no longer have, that you do not have an obligation to file Form 8938 Form FBAR. Basically, it doesn't. Filing Form 8938 does not exempt you from having to file an FBAR if the specified foreign financial asset triggers an FBAR and an 8938 reporting obligation. As always, if you have any questions whatsoever relating to any of the topics that have been discussed thus far, please don't hesitate to reach out for me. My contact information, as you can see, is here. You can get me by email. The disclaimer that I've been giving over the course of this webinar series remains in effect. The information that I'm reviewing with you is very generic, and it's not customized in any way, shape, or form to your individual circumstances. So I strongly encourage you, if you have questions, to reach out and speak to a tax attorney to get practical and sound advice. This is a veritable minefield, and it even stumps tax lawyers and accountants and enrolled agents who specialize in this field. And this is, of course, an area that we are in every day. Yet it never ceases to amaze me how there are always new and emerging issues that come up that are mind expanding and that cause me to have to get my hands dirty in the regs again, and to double check things and to research things. So if a tax professional has to do due diligence, and this is his or her specialty, then you can only imagine the pitfalls that exist for a layperson who doesn't deal with this on a regular basis and who doesn't have the expertise of the tax professional. So again, don't leave it to chance. Be sure to reach out and speak to a tax professional to get solid advice on whether there is a reporting obligation. I look forward to seeing you in Module 4.